Hey guys, welcome back. It is another edition of Investing in Huntsville.
All about the money today.
All about the money. It's the money show.
Show me the money, Tim. Hey, you got any money you want to lend me?
No. You know what? I don't really deal in money anymore. I'm a credit guy. So
one thing I learned in real estate is you always are looking for money.
Without a doubt. Yeah. So Tim Knox, the realtor, Zack Childress, the investor, and this is the show where we talk about investing in real estate in general, but we do talk a lot about doing it locally in Huntsville here because that's where we be.
That is where we are, and that is where everybody seems to want to be.
I had 5 calls this week from investors out of state wanting more info on good old Huntsville, Alabama.
Good old Huntsville, Alabama.
Yeah. And, I'm like, oh, no, don't come here because me and Zack are the investor here. You guys stay in California.
I actually talked to a guy from Seattle. A management company referred him to me, and I was just talking to him. He's bought 20 properties here. He lives out in Seattle, and he was just asking a lot of good questions.
Yeah.
And he runs across the same issues as we do here too, because he sees a lot of stuff from like wholesalers, and he's like, "Are you guys buying any of those?" And I'm like, "No."
Yeah, yeah. You can't. On every street corner, there's 20 realtors, 25 wholesalers, 3 investors, and 195 mortgage people.
Oh, man, it's crazy.
Anyway, this is the Money Show. We are going to talk about money. This is is this 4? 4 or 5?
4.
We started up the podcast talking about Huntsville in general, why invest here, how to invest here. Last week we talked about the various areas of town and what the opportunities there. And today we're talking about the money. Because, Zack, money makes the world go round.
Well, it definitely makes it go around, but it also allows you, depending on the type of capital you have access to, allows you speed in the market.
Right.
And that's why I think this show really is probably the one piece that most investors tend to let hold them back from execution. I have a whole series called 4 Pillars to Success, and one of them is Pillar 3, and that's from contract to close. And one of the greatest fears that I notice as an educator and a coach is that a lot of people are afraid to execute on the offer because they just don't have the confidence on where the money's coming from. Right. And so that's why I go, well, let's go all the way back to Pillar 1, the foundation, which is building your money sources. And it changes a lot of the ability for an investor to move when they realize, one, there's different funding sources out there. And, and we're going to talk about
which we'll talk about. Yep.
But it's also about what is their current situation. So, for example, when I got started, I was not bankable. I had my credit was in the 500s. I was a 20-something-year-old kid trying to buy $500,000 houses in California. I couldn't go to a normal bank. Right. I had to use what we classify as alternative funding. And so we'll dig into some of that today.
Yeah, well, this is what I want to talk about, the different types of money, how to access those types of money. Why should someone lend you money? Because that's one thing I get a lot of phone calls from investor wannabes. Hey, I found a great deal. Can you find somebody to give me money? Okay, so let's start. Where do you want to start in this? You're the driver on this show. You want to start with the 4 types of money?
Let's start with the big umbrella and then work our way down.
All right, go for it.
So in real estate investing, you can really simplify the money into 4 real pillars. And pillar number 1 of the funding side is all about traditional lending. Okay. And we'll come back to that. Pillar number 2 is really about alternative funding, which is a great resource, especially when you're starting out. And then pillar 3 is what we call bridge capital. And that is a missing link for a lot of investors getting started, is they just don't understand what bridge capital really is, or also known as gap funding. And then pillar 4, which is the reason that I believe I have such longevity and the reason I'm able to do so much so fast, is private funding. And so those are really, and we can take each one of those and move through them because they all have different legs underneath them.
Okay, well, why don't we do that? You take us through them and I'll throw questions at you as I have them.
So when we look at like just traditional funding, this is what we refer to as just bank financing. Okay. It is more challenging to get because it requires full documentation. 2 years tax returns, a decent credit score. Most lenders in our town, if you've got a 620 or higher, they'll fund you. But there's some great programs because they typically have the lowest interest rate for like our buy and holds. We absolutely need them in place. Or even for our fix and flips, because a lot of the traditional banks offer you what's known as a construction to perm loan. And they typically will give you 90% in most cases of the purchase contract and 100% of the construction and draws. But they'll give it to you on an 18-month interest-only payment. Okay. So it allows you to get the property fixed. They give you the money to fix it up, and then you can sell it within that 18 months. But they also do, traditional banks do buy and hold type loans. And what I love about what some of our local banks do is they do ARMs. So they give us these 5-year ARMs.
ARM being an adjustable
rate mortgage. It's fixed for the 5. Then at the end of the 5, you can, for $5 to $1,000, you can roll it into another 5 and reestablish the interest rate if it's dropped. Now, the beauty of those loans is they're readily available. Now, I tend, just staying on pillar 1, I tend to stay with more local, smaller banks.
Right.
And the reason that I do that, and this is very important, listen up, is I love the BRRR strategy.
Explain BRRR.
BRRR is when you buy it, you renovate it, you rent it, and then you refinance the property. And the reason that it works so well with the model that we work with is because we work with these small banks that are what's classified as portfolio style lenders. So what does that mean? That means they lend their own money out. They're not selling you off to Wall Street. So where like the big boxes will do these types of loans, you have to meet a certain criteria, or also known as seasoned of ownership. And that's important because if you go to like a Regions or a Bank of America, they're going to want you to not only have that property stable, but have ownership of it for sometimes 6 months, which means that if you went and borrowed money or used your own money to buy that house, you got to wait 6 months before you can refinance it and take your money out. Where a lot of the local traditional banks have 0 seasoning period. So I can buy it today. I can start the refinance tomorrow.
Okay. So let's talk about how hard it is to get one of these loans.
Well,
because it's a lot like getting a mortgage.
It is a mortgage.
It's a bank. You've got to qualify. So you've got the short-term interest only, where you're paying interest payments every month. You are not paying the principal. The goal there is to either sell it or cash it or do something within 18 months.
Yeah, that interest-only payment, just to be clear, they don't typically offer that in a long-term hold. It's for a fix and flip.
Right, and you don't want it in a long-term hold.
No, you don't. No, you don't. And so they are harder to qualify, but don't let that deter you. I mean, if you've got 2 years of running history of your employment and your tax returns, and you've got a 620 or higher, I would absolutely encourage you to start talking to them, especially on your fix and flips. If you're trying to do buy and holds, the problem is it goes back to the old saying. We run into a lot of investors that are equity rich but cash poor because they tend to do what's called a straight purchase, where they put 20% down, 20% down, 25% down, and they run out of money. And this is why we do the BRRR strategy. So, you definitely want to make sure you're working with the right bank that allows you to BRRR out quickly.
Yeah. So with the BRRR strategy, though, you've got to have enough equity in there to get your money back out.
Well, if you want all your money out, but let me explain what I mean by that. Okay. If I'm buying let's just say $100,000 house, and I got to put 20% down, that's $20,000 I got stuck in that deal. But if I can buy that with my own money or with a private lender or even a non-traditional lender's money, and then go back and refinance it, the big difference is on a purchase loan, they base the loan on the contract price. On a refinance, they base it on the appraised amount. So if that property even appraised for $120,000, you take 80% off of that, that's a $96,000 loan, right? Meaning that I will only have $16,000 in the deal versus $20,000. Right. So my return is higher.
Yeah. I think you said something there I think is key to anything related to banking, and that's relationship. Before you even start this, you need to go build a relationship with a bank, with a banker. Yes. Even if it's just an assistant manager who's sitting there handing out deposit slips, you need to start building and talking about that relationships with those sources.
Well, it is. Oh my gosh, I can't even speak of how important it is. This is why, like, we're constantly, I even have a free guide I'll let everybody have, and it talks about the 4 pillars. But this is why we tell everybody hey, look, start with pillar number one in your business. And the first thing is finding funding sources, building relationships with banks. And some people are like, well, I don't think I'm bankable. Well, you don't know what you need to do until you go talk to them, because they'll say, hey, look, we'd love to work with you, but you need to go do these 3 or 4 things. Well, what that does is it gives me an action plan. It says, okay, now I got to go work on these things so I can come back and become bankable.
Yeah. And working on those may take months.
It could.
Because you know as well, I want to do it right now. Right now, Zach, right now. So you've got to start planning ahead. So, okay, so that's number one is the traditional bank. What's next? So
number 2 is what we classify as non-traditional. And this is how I got started. And this is where a lot of people have to get started. And it's a beautiful thing. What branches down? Real quick, pillar 1 is not just banks for residential. It's banks for commercial. It's banks for everything. They'll loan on everything. You just got to find the right bank. Pillar number 2 in funding is non-traditional. And these lenders do all the same things. They'll fund for buy and holds. They'll fund for fix and flips, apartments, commercial. The difference is you're going to pay higher interest. Where like a traditional bank right now for an investment property is, I just got a quote yesterday about 6.5. But that was on a commercial 8,000 square foot building. Where in the non-traditional, it can be anywhere from 9 to 14%, right? And so it's a big difference, but it's a higher risk loan for them because if you're working with a true asset lender or hard money lender, which fall under non-traditional, they don't look at your credit score. They don't look at your work history. So all that heavy qualifications don't fall under this. And they're looking at the asset specifically, and do you have some kind of experience? And that's where they base their interest. And some of them even charge you points up front. Like, for example, I'm a lender in town. So I'm pillar 3. I do bridge funding. And so I could care less if they have a job. I never pull their credit. Like, I don't care. I just look at the deal. And is it a good deal? And is my money safe in that deal?
You look at the math. How hard do you look at the person?
Well, that's a good question because I'm looking at the deal specifically and the numbers. And if they default and I foreclose, do I get it back? And is it clear?
Worst case, if you have to default, is
but
the
I will
something
say
you
this
want?
to you straight out. I have yet, and I do a lot of bridge loans in town. I have yet to do one with someone I didn't know. Typically, they're people that are at my community or members of my RIA, or they're deal partners or coaching students. So I know them, and it's a little different. I'm not just some blind company on the web.
You're not an ATM machine, which a lot of folks want you to be.
Well, yeah, absolutely.
So a couple of things you talked about is borrowing money to invest. You're going to expect to pay a higher interest rate than you would if you were just buying a house.
Oh,
those what are they at 2 points now to the rate for investors on a lot of stuff?
Well, I don't know. I mean, they range depending on the bank. I can tell you this: when I get quotes right now, they range anywhere from 6.5 to 6.9. On whether it's a flip or if it's a buy and hold through a traditional bank. Through non-traditional, which is how I had to start because I didn't have a credit score. I was not in the position to have. Because I left my job, and so I didn't have income when I got going. And they don't look at that. So for the person on here that's watching this, that's like, well, look, a bank won't work with me. How am I ever going to rehab a house? I must just have to wholesale. Well, that's a problem. And the reason is because they think they have to wholesale because they haven't figured out the money sources yet.
Yeah. So the other thing, if I go to a bank looking for money, are they going to take into account the after reno value of the house? If I'm going to do a buy and hold, are they going to take into account the rent?
No. So, well, yes, on a buy and hold, if it's a straight purchase, they're only looking at LTV, loan to value, which is what's on that contract. Even if you know it's worth 200 and you're buying it for 100, they don't care. They're looking at the contract as the value. If it's a rental, they do look at what's called DCR, debt cover ratio, and they look at you as a whole with that investment. Or if you have multiple companies like me, they do what's called a global DCR. So they take all of your company's debt and income and say, okay, do you meet the 1.2 cover ratio? And I always make them use my global because I end up at like 3 and 4, cover ratio. So it's a no-brainer for them to fund.
Explain cover ratio.
Debt cover ratio, meaning that they want to know that for every dollar they're lending you, basically, that you're bringing back $1.20 on that dollar.
Okay. So, and that's the thing I think a lot of people need to remember these folks at the bank in charge of crunching these numbers, they know what they're doing.
Oh yeah.
They crunch the crap out of those 100%. Numbers, and you're not going to go in and really give them a dog and pony.
Well,
it's all about the math.
They have an inside view.
Yeah.
I'll give you a prime example. We're looking at an apartment building. We were expecting to raise rents, get it stable, and that the value would hit about a $6 million ratio. We went to a local bank in that city, and she gave us some amazing information. She's like, look, I know this area. I fund in this area. You're never going to get that value, which was golden information, right? And that takes that relationship and working with the right local type of lender that works those asset classes in that market.
Gotcha. All right. So what's next?
So the next one is the missing link for a lot of people, and it's pillar 3 of funding, which is known as bridge capital. And bridge capital could be broken into bridge capital, gap funding, transactional funding, mezzanine funding. It's all of that, whatever you're short. And so, for example, I, as a leader of the investor club, I hear people say to me all the time, well, Zach, I have to wholesale. And I'm like, why do you have to wholesale? They're like, well, I don't have the down payment. I'm like, no, you don't have to wholesale. You just have to learn where all the money's coming from. So this is a world that I know very well. I learned it years ago and thought, oh my goodness, it's the magical hole. And this is, so bridge, gap, transactional, mezzanine, they all understand that they're going into what's known as a second lien position.
Okay.
So that means they've got a primary lender to give them the money to buy it, which is first lien, and they need the down payment, or in some cases, they need the construction costs because they don't have it. Well, that's where a lender like me or any other bridge or gap funder out there steps in and says, hey, we're going to give you this money for the down payment or the construction, and we're going to go in second lien position. Now, it is the highest risk loan.
Because you're behind the bank.
Oh, you're behind the bank. You're in second position, which means you could get wiped out if the deal's not a good deal. And that's why the interest rate is so much higher.
Yeah.
And they can range anywhere from 1.5% to 3% per month.
Okay.
And it's a high interest rate, but people get stuck on that and not the payment. Because think about this, let's just call it 2%. If they need $30,000 for the construction, 2% is only $600.
Right.
You know, it's not this massive payment, but it's a small amount with higher interest, and it's at a higher risk.
Yeah, and you expect to be paid back how quickly?
Well, we put mortgages on the property. We give them a window 3 to 6 months, depending on what they need, but.
So it's a short-term bridge.
Just like any asset or hard money lender, like under non-traditional, they're only typically 6 months. Some will go 12, but most of them want to play in 6 months. So it is a game of speed when you're using that expensive money, right? And they do that for a reason. Same reason I do it is we know in the long run that payment will never sustain itself on that asset. So we have to put it out and expect that short-term run to get it back.
Yeah, yeah. So you are just providing money to bridge the gap until they can get stuff done. Do banks typically lend money for the renovations?
On a rehab, they'll do what's called a construction to perm. And so that's where they'll say, hey, we'll give you 90%. I'm just using this as an example of the purchase, $100,000 house. They'll give you 90. You got to bring 10,000 to the table.
Okay.
And they'll say, and we'll give you 100% of the constructions and draws. And so they'll set up a little line of credit for you. And then as you're working, you call them in, they'll come out and inspect and say, okay, you're 30% through, here's a 30% draw, right?
Gotcha.
And they'll loan that money to you as you move through the project. Here's where a lot of people go wrong and they don't understand. Most lenders will never give you an initial draw up front. And so they want work to be done before they give you a draw. So they're always on the back end, and your contractor's not going to sit around and wait. So when you're looking at executing that deal and you're like, hey, I got to put 10% down, but you better set a reserve for probably that first draw so that you can pay the contractor and the bank can pay you back.
Gotcha. Yeah, those contractors are a little touchy when it comes to their money.
They want their money.
So, all right, so what's the next one?
So the fourth is private investing.
Okay. Is this hard money?
Nope. This is not hard money. Let's be very clear. Private money gets misconstrued in our marketplace because a lot of people use the name private money and they're really not. A private lender is somebody you know.
Right. It's just an individual.
It's just somebody you know, you go to work with, you're at church with them. I mean, look, I meet private investors all the time because I am not embarrassed to ask people if they have money to lend.
You stand out there with a really nice cardboard sign.
I mean, I just ask everybody, like, hey, what are you doing with your retirement?
Yeah.
Well, I don't know. Well, what are you making on it? 3%? Would you like to double that?
Right.
Well, I'd like to double that. Well, let's have coffee and talk about my private lending program.
Okay.
And I'm constantly doing that and raising, I mean, in the last 2 weeks, well, I won't say how much, but I've raised a whole bunch more in the last 2 weeks. But private lending is one of the, like, I don't know how to say it, this mystical thing that's out there. And it's not some genie that just pops up and says, hey, I'm a private lender. They're literally sitting next to you.
Right.
You just don't know it because you're not confident enough to start talking about it. And there is some legal side of it, right? Like if I'm borrowing a private lender's money on one deal, well, then they're secured by a mortgage. But if I start going out and trying to borrow money from a whole bunch of different people to put in one deal, well, that is like putting on an orange jumpsuit and going to jail because that's called pulling money, and you have to put a PPM, you have to file a security, and it's more of a syndicate type operation. So private lenders, to be just in the open about this, it is a process of teaching people how to communicate with people that have potential money. And the biggest thing that I do when I'm teaching people how to raise private money is stop focusing on you. Because we tend to go into a world of talking to people about money and we get real nervous because our parents always taught us don't talk about money, right?
Yeah.
And now we have to, well, especially for the new person that hasn't done any deals, they go into that conversation like, well, why would they lend me money? And the shift you have to make goes back to pillar one of building your real estate business, which is your foundation, which is putting your team together. When I'm working with new people and I'm telling them to raise private money, I'm saying to them very clearly, stop talking about you and start talking about your team. Emphasize how great they are and how long they've been doing it so you get the focus off of you and who you've put around you. And that helps. And there's a whole bunch of, like, you got to have a good attorney involved that can do the mortgages and drop the promissory notes. And you got to make sure that they're very clear that you're never touching the money.
Right.
The money goes to the attorney. The attorney funds the deal. When you sell it, they pull your money out and they send you the check. But with our private lenders, man, they range. Some of my private lenders, I pay 4%, some I pay 8%, and they're all in between, depending on the deal and really what they're making. I've got one guy that I pay him 4% because he was only getting 2% on his retirement account. And I simply used the one line that I say to everybody, how would you like to double it?
Right.
And he was like, I'd love to. I said, well, then cash out the stock market and come with me.
So I think, again, you make a point there. You're, as a private lender, you're just not handing somebody a bag of cash.
No.
I mean, there are forms and there's a trust factor.
Oh, a huge
and
trust
that's one of the
factor.
things that I've had people come to me to borrow money. You know, that $8 I keep in my back pocket.
I was about to say, I keep asking you.
You keep asking me. Someday I'm going to go cash out my 401k, all my Tesla stock. But the thing with me is I like you. I just don't know if I like you enough to give you my money.
Yeah, right.
You know, so if I'm an individual approaching somebody like you and I have a deal or there's a deal in place already and I need extra money, what do you look at? I know you look at the deal, you look at the numbers.
Well, first off, I want to clarify something. Okay. I always make sure people understand I'm not a private lender.
Okay.
I'm not. A private lender is very specific. As we say, it's lazy money.
Right.
It's somebody that you know that has money and it's not doing anything. They're not an investor. They're not like out there being active working their money.
Right.
Private lenders are lazy money and they don't know what to do with it. Okay. When someone comes to me, I'm a bridge lender, and I tell them up front, hey, look, I'm a bridge lender. I'm taking high risk and I'm high interest. And they'll say, well, what do you need to see? Well, I send them to the funding website where they fill out their information. And I'm looking at certain things like and I only do it in my local market because I know this market. Like a lot of times they inflate the ARV or they use comps that aren't relevant. And so I'm really underwriting it the same way I would if I was going to buy it.
Right.
And I'm like, is it a safe deal? And here's where a lot of people go wrong. They go, oh, but Zach, with your money, it's still 70% of ARV. Well, I don't play that game. Because what they're not taking in consideration is the first lender, my funds may only be 70%, but they've got closing fees, real estate commissions, concessions, they've got payments, taxes, fix up. They've got all this stuff that still has to get paid through the transaction. So my threshold typically falls around 80 to 85%.
Right.
If it hits, let's just say it hits 85, well, I'm looking at the profits. If the profits is high, I'll still fund it. But if the profits are 18, 20, I probably won't fund it.
Okay. So the profit has to be high enough for you to
If
to
it's
make
on
a
the
good
85%.
return. Yeah.
If it's on the 85%, because what I don't want to happen is go into 6 months with this and then them come back and say, hey, I've got to extend for another 6 months. Well, I already know that means the first lender extended, I extended. So these payments are killing them.
Yeah.
And you just don't want to, as a lender, you want to just look at all the precautionaries of what they may not see, because a new investor is so emotional and they just want to do the deal to make money.
Right.
And we're the ones looking at it going, well, where's all the holes? Like, how could this thing go wrong?
Yeah. And what happens when it goes wrong? If you're the bridge lender on something, there's a bank in first position. If something ditches, what happens?
Good question. I typically, if I'm being defaulted on, I execute my right to default and I go to the lender and buy them out if they'll allow me. If not, I have to then file foreclose, which then means the first lender has to be notified, which means then the first lender has the rights to step in, and then it can process through what's known as a deed in lieu of foreclosure. And if they'll grant that to me, that's fine. If they'll do a deed in lieu, then I'll just step in ownership and finish it out and pay off the first when it sells.
So you'll actually go in and offer to buy out the lender.
It depends on the lender. Like if it's a lot of the local guys in town, they'll even tell me. They'll say, hey, Zach, I know you got a second on this. They're defaulting. I'm like, okay, well, what's your buyout? And they'll say it's 120. Okay, I'll get you a check. Because then I have full control.
Yeah, and a lot of times you're going to make way more money if that happens.
Oh, please.
You like a good default.
Well, we don't want them, but
Yeah.
if we're lending correctly, then it won't hurt us if it happens. So
Gotcha. All right, let's talk about hard money.
okay.
Tell me all about, why is it called hard money?
Well, way back in the day when I got started, it was really kind of classified hard money because it still had this negative condensation as like mafia money, right? It was like, if you default, they're going to come hunt you down,
come break
right?
your kneecaps.
Yeah, they're
Just
going to break
business.
your kneecaps. Well, I mean, and it was an alternative funding source. And a lot of these guys out there that started hard money companies realized like, it's all about the deal anyways, right? If the deal's safe, fund it. And they're charging, like back when I did it, they were 16% interest.
Yeah, interest rates are crazy.
It was insane. But now over time, the name hard money started kind of getting a negative vibe. And so they switched their name to asset-based lender.
Oh, okay.
So it's really the same thing.
Yeah.
But you got to be careful because a lot of people will advertise as hard money and asset-based because they want to charge the high interest. But all they are is a mortgage broker because they're still going to ask for your credit, your financials, your documents. And if they're going to do that, you might as well go to the bank.
Yeah, and it isn't the point of hard money that you don't have to jump through all those hoops?
That's right. That's the whole. That's it.
Yeah.
And we have local hard money lenders in our town.
Oh, yeah.
And they don't go through all that stuff. Neither.
Yeah. So is hard money, I mean, it's more costly than anything else.
But you shouldn't focus. Look, I'm going to tell anybody this. I don't ever look at the cost of money. I look at the profits with the money.
Good point.
So I'm looking at the deal and I'm going, okay, they want 12%. Let's stick it in there. What was my payments going to be over 6 months? Look, I'm still making $38,000. Sounds good. Let's go.
Yeah.
One thing I've always said, and even at my boot camps, we get into this funding stuff and they'll say, oh, well, that's expensive money. And I'll say, okay, well, great. Then use your own money.
Right.
Well, I don't have any money. Then what are you complaining about?
Yeah. Yeah. Well, I know a lot of investors start with hard money and eventually work out of that.
They do, because what happens is they start using hard money. They start selling properties. They build up some liquidity in the bank. They have money now. They've been working on their credit a little bit, so they're showing a track record. Now they're more bankable.
Right.
They can go into a bank and say, I got 50 grand in the bank. I've been doing deals the last year and 2 years. My credit's been worked on. And the bank's like, you look great.
Yeah.
Let's work with you.
Yeah. Break down a typical hard money deal. Okay. If I come to, and I know you're not hard money, but if you were, you know how this works.
Yep.
I'm going to come to you and say, Zach, I got a deal here. I need $100,000. What are the terms for your hard money if you loan me that?
Well, in hard money world, it's going to depend. They structure it so many different ways. Some hard money lenders will do what's called a 10% flat.
Okay.
So if you borrow $100,000, whether you sell it in 2 months, 3 months, 6 months, 8 months, it's 10% on the $100,000.
Okay. Anything up front?
Typically there is some will charge you a point and 2 points up front and some doc fees, some processing administrative fees. Some will do that, and some will just roll it into the back end of the loan because all those fees now they're making interest on, right? And so it's a more profitable venture for them.
Yeah, I think the last time I talked to a hard money guy, he was charging, I think, 2 points up front and 14%.
Well, and that's the other model. So the other model is it's anywhere from 2 to 4 points up front, and point being 1% of the loan amount. Okay. You got to pay that up front, and then they're anywhere from 10 to 16% annualized interest only payments, just to be clear on that. Okay. And then one of the most important things you could do if you're talking to hard money lenders is make sure that you have the rights for an extension. Okay. Sometimes they'll charge you a point for it, but it's well worth it to just have that in the agreement. And so it's points, it's interest, it's terms, 6 to 12 months. And there again, they'll throw language out at you like, hey, we'll loan you, 80, 90% of the purchase, 100% of the construction, not to exceed 75% of the ARV. And this is the big difference. So hard money lenders don't loan or base their loans like a bank does on the contract. They actually look at what the ARV is, after repaired value, and base their overall accumulation of loan amount not to exceed their risk factor, which is typically anywhere from 65 to 75% of that ARV. And so some people will come in and say, oh, well, my whole deal, the purchase and the construction is under their 75% benchmark. I should get 100%. But it doesn't work all that way, because in today's world, they want skin in the game. So you still might have to bring that 10% of the purchase price into the deal. Some local guys make you fund the construction. So they'll say like, hey, we'll fund you the rehab, but you got to fund the construction. And they actually make you write the full amount of the construction and put it into escrow, and it sits in a draw account. And so they know that if something happens to you, that money is still sitting there and they can finish that job.
But what if someone doesn't have that money to put in?
Well, that's why they have to come to
That's where they come to a bridge cap. I got you.
Yep.
Yeah, one term that I don't hear it very much anymore, but this was really big back in the 80s. Remember Robert Allen?
Oh, yeah.
Carlton Sheets, the TV guys, and they always wanted they advised you to do it with OPM.
That's private
other people's money.
Well, OPM is all of that, right? It's
exactly.
Private money, it's bank money, it's hard money, it's bridge money. It's teaching people, hey, look, your money needs to be used correctly. Use as much of other people's money as possible, because the actual return value is greater. But look, that was a big thing that I learned real quick when I was living in California, and a lot of people lived by that. When I came to Alabama, it was like a whole different world. Now, I was born here, but moved back here. No one wanted to borrow money. And so the problem that was going on is they were having to do one deal, sell it before they could do another deal.
Right.
Do that deal, sell it to do another deal. And I was trying to explain to them, like, you're missing opportunity. This is an opportunity cost, because you don't want to pay interest on a borrowed money. But if you only had to put 20 in this one, 20 in this one, 20 in this one, 20 in this one to get them rehabbed and sold, now you got 4 of them that you're not going to make 100, 150, 160 on all of them, and you use the same 100,000. That's a mindset shift that we have to go through in some of our culture, that especially in my generation, your generation, we were just not taught to go borrow money.
Right.
It was, if you can't pay for it, don't do it.
Yeah, exactly. Talk a little bit about the dangers of money. If we've only got 10 minutes left. But a lot of people, they get in over their heads. They don't really do the math. They get in, they don't realize what the carrying costs are going to be every month. Yeah. Talk a little bit about that. Based on your experience, what have you seen investors get into trouble?
Well, they get in trouble because, one, they go borrow money and they don't understand the actual terms of the agreement.
Okay.
And in some cases, they speculate lower or more ambitious processes, and they don't have their reserves or their backup plans. And so I'm always coaching people like, look, if we're borrowing money, we better make sure we account for whatever capital we got to bring, whatever that first draw is. And if the payment's $1,000 a month and we're going to hold it for 6 months, we better have that somewhere too. And so, for example, if the deal's good enough, I will bridge the construction, the payments, and the down payment. You follow me? to be sure that it is there to sustain and get closed. But a lot of times they have this idea they're going to get in, they're going to do it fast and be on the market and sold in 3 months, but they don't take in consideration that real estate investing and flipping is a moving target. And it has a lot to do with like cities and inspectors and contractors. And you might have the greatest intention in the world, but these outside forces could slow you down or even halt you completely.
Yeah.
And in some cases, you could get hit with something that you know very well that could add an extra $20,000 to the project. Right.
Yeah.
I got one in Madison that's driving me crazy because this has happened.
I'll trade you 2 in South Huntsville for 1 in Madison.
I'm good. I've heard your story.
Let's play poker. Oh, I got to tell you, I got to update you. So, all right. So to wrap up, it's all about the money. If you can't get the money, you're not going to be able to do much as a real estate.
You just have to be a wholesaler.
Yeah, it really quickly, and I think everybody probably knows that. Define wholesaler.
Oh my goodness. Wholesaling is nothing more than learning the skill sets to find great deals, negotiate great deals, and then selling your equitable interest in the contract to another buyer.
Right.
The downside of it is you have a job. You're never building wealth. You're not taking the lion's share of the deal's profit. And let me just be clear. Most of the time people start as a wholesaler because they haven't learned all the other things. There's a great guide that I give out. It's localinvestorclub.com. Localinvestorclub.com. It's a guide. It comes with videos. It's free, and it explains these different pillars so that people understand, like, no, you don't have to be a wholesaler. You just have to really understand what you got to go find.
Right. Yeah. So I think at the end of the day, the advice I would give is do your homework.
100%.
Learn about this. Just because
slow down.
That's the big one.
Just
oh my God.
Slow down and get everything in order so that you can move forward faster.
Yeah. I talked to a young investor here 2 or 3 weeks ago. He just wanted to just get started. In fact, I pointed him in your direction. And he's like, I've got this little bit of money. My mom and dad are going to front me. I've watched some videos. I just got to find something to buy.
Yeah.
I need to find something to buy. That's what he kept saying. I need to find something. What advice would you give this young gentleman?
Well, I would simply ask him 4 very important questions. That is part of our 4 pillars, which is number 1, do you know the market and market segmentation? Where are you going to start investing at? Number 2 is have you put your funding sources together? Number 3 is who's on your team? And the team is very big, right? Agents, contractors, management companies. And then number 4 is just about, do you know the process to execute for lead flow?
Gotcha. All right. Zack Childress, you've been doing this a long time. I know you've had
21 years.
We'll do a whole show on deals that went south one day. That'll be a good one.
Boy,
yeah,
I lost $300,000 on one.
Hey, save that for next time. So, hey, if folks are interested in investing in Huntsville or really investing in general, because what we talk about here has no geography.
No.
This is universal. How do they get in touch with you?
The best place to find what we do and get some free resources is localinvestorclub.com.
Okay. We will put a link there. And of course, as always, we've got Revolved Realty here. Almost 100 agents now.
Wow.
Gosh, it's like herding cats.
200.
It's like herding deaf, dumb, and blind cats most days. But we work with a lot of investors locally as well as those from out of state. We actually have our little group of, I call them my investor team that we handle. So if we can help in any way, our contact information is below. So, all right, guys, that concludes the money show.
The money show.
Money show. Leave the money on the dresser and get out.
Show me the money.
All right, guys. We'll see you next time. Bye.